What surprised us most this year has been the stickier inflation prints. And really what that has done is pushed out the easing cycle and caused tighter financial conditions for longer. Now, when we think about those long-term impacts from tighter financial conditions, we're now getting more concerned about that soft landing narrative coming into fruition. For us, that would mean that the current tight credit valuations and equity valuations would be warranted. However, if we have to start to shift to a higher for longer narrative, that could lead to spread widening and potential drawdowns across equity markets.
I believe the most surprising thing to me for the first half of the year has been about consumer performance, specifically the bifurcation of consumer performance. As you look at the consumer and how they perform, you have the high credit quality, high income consumer, or the low credit quality, low income consumer. And they tell a story, of course, of trends in consumer performance. But what we've actually seen is an additional subset of consumer performance. You see the difference amongst the age cohorts. So you see boomers performing better than Gen X performing better than millennials, and the Gen Z, well, unfortunately, they're struggling the most amongst all the age cohorts. And that's actually across all lending product types.
I think the thing that's been the most surprising this year, and as well as last year also, is the resiliency of the credit markets, not just here in the US, but also globally across Europe and the UK as well. Looking back at 2023 and into the first half of 24, there's been a lot of volatile periods in the credit markets, but each time credit spreads have moved tighter and kind of battled through some of the risks that they've encountered. The market was saying, hey, growth is better. So spreads continued their march, and here we are at fairly tight levels. And every step of the way, it's been a one-way street, and that's been surprising.
I believe the biggest surprise for us has been the fact that when we look at the return so far year to date, we've seen a decent return environment, total return and excess return for high yield. But really what's been surprising is we've seen spreads tighten to inside 300. Looking back at the fall of 2023, I would have thought that the lower quality segments of the market really would have been a driving force in that. But really what's happened here is we've seen all quality segments essentially have the same total return year to date, which has been surprising. As when you look back at 2023, the lower quality segments of the market were actually looking quite attractive. We just haven't seen that catalyst quite yet to drive spreads tighter there.
Now, if you look at the Euro credit market, there's been hardly any volatility. So it's basically been one straight line down in terms of where spreads have been going. And if you compare that, for example, with the government bond market or equity, for example, there has been much more volatility. And you could argue, of course, that some of the themes in those markets also apply to the Euro credit market. So that's why we think the limited volatility has been surprising.
When you think about a surprise, you have to think about what you were expecting. And so coming into this year, we had seen already Treasury yields fall. And I don't think the conventional view was that we're going to see yields really go back up, but they are higher. And when you play that into emerging markets, we see a lot of emerging countries, really in Latin America and in emerging Europe, that had already started cutting because, of course, they had hiked quite a bit. And they have continued, for the most part, that cycle, but they have slowed, moderated, maybe spaced them out a little bit more, which makes sense given their internal dynamics, growth, inflation. And I also think it goes to really the credibility of the central banks once again in these countries. But what is surprising is we have seen spreads compress quite a bit in emerging market corporates. This is in contrast to the EM sovereign space, where we do not see spreads compress as much. And really, some of this is about the supply. We have seen good issuance this year, multi-tranche deals, and also some specific election-related, geopolitical, political issues in specific countries.